everybody, and welcome to Wall Street Hackers, one of the most popular shows on the Pod TV network. I'm Nick Pallavito. I'll be the moderator for today's show, and we're going to bring in today the hacker himself on one of the most popular programs on the Pod TV network. He received his bachelor's degree in economics from UCLA, his law degree from the University of Miami, and his master's in business administration from NYU. Then he spent 17 years in New York City working with and on Wall Street, developing an expertise that very few people would acquire over those 17 years in the stock market, the markets in general, how they work, and how you can choose some of the best and safest investments for yourself, realizing this show is for educational purposes only. If you're going to do investments, please consult your own financial advisor, which is our disclosure. So with no further ado, we're going to bring the hacker himself and let us know about the markets, the quote of the week, the stories of the week, and of course, Peter's picks. With that, we'll bring in Peter Bennett. Peter, welcome to your show.
Thanks. Hi, audience. So welcome to the 328 episode of Wall Street Hackers, 328-24. And you can catch a new episode every Thursday or Saturday, starting every Thursday or Saturday at 1, depending on your distribution channel. So we always start with the markets. And this week, we're going to flip things around a little because we're going to do the quotes of the week because they really sum up the ongoing situation in terms of the Fed, the markets, the interrelationship between the two. And our panel discussion of the week will also be on that topic. What is the Fed doing and why is it doing it? That's the question we're going to be focused on. So these quotes really sum up a lot in terms of what's been going on. So first of all, from Sunday's Barron's, these are selected sentences and quotes from the article. The everything rally rolls on. Thank you, central banks. What a wonderful world indeed, and thanks also should go to the world central banks led by the U.S. Federal Reserve, which have all but green-lighted lower policy interest rates in coming months in the expectation that inflation will continue to make downward progress without triggering recessions. Right. The FOMC median projections for 3 cuts in December remained, even while the panel revised upward in median guesses for 2024 economic growth and inflation. So while lowering its projection for unemployment. So it lowered projection for unemployment, it raised the economic projections, but it left the 3 cuts that they project. Federal Chair Jerome Powell characterized the higher inflation numbers as a result of bumps in the January and February data. Another quote of the week. This comes from a company called Mott Capital Management. It's one of the many companies I follow. Quote, the Fed plans to cut rates 3 times in 2024, despite rising inflation expectations and a recent increase in inflation rates. Inflation swap markets is predicting inflation rates of 3.4% in March and 3.2% in April. And Fed forecasts show a higher neutral rate and a more robust economy, indicating that ultra-low rate interest rates may be behind us. So that's saying maybe this isn't the situation of, we're heading for low rates. Meanwhile, WTI crude was at $81 roughly a barrel yesterday. It was at $68 a barrel on December 12th, 2023. And Wall Street Hacker said many times during the fall, the energy markets have been going down in prices, and this is going to lower inflation. And everybody thought, inflation's gone. Everything's under control. It doesn't work that way. And we said if energy even just stopped decreasing, it would impact inflation, but that it was likely to rise. Well, energy prices are rising, and now we're heading soon into driving season. So we'll see where they go. Plus a little footnote in the conspiracy theory department, I think tech and definitely the mainstream media put their thumb on the election cycle when President Biden beat President Trump last time. But if there's one sector that's going to be putting their thumb the other way, nobody will admit it, but, these companies really do influence things. Maybe they'll not want to lower rate energy into the summer as much as they could, because I don't think the energy sector is happy with President Biden, that's for sure. So we'll see what happens. But I think energy prices would have been rising anyway. There's world global demand keeps increasing, and supplies probably will not keep up with them. Meanwhile, unemployment did rise to 3.9%, but it's still near a 50-year low, and there's still 8.8 million unfilled jobs. Now, 8.8 million is a huge amount of unfilled jobs. So where's the progress there? And then the U.S. deficit, of course, maybe the worst area when we're talking about potential inflation. They're talking about the deficits running at 1.6 trillion in 2024. And it's actually worse than that because they're just talking about the gap deficits. They're not talking about the unfunded liabilities that are even a bigger tsunami that is coming. So exactly how can the Fed be confident that inflation is under control or even close to it, where they've been sending a pretty positive message? Well, that will be our discussion of the week. So what to do? Well, first of all, we believe the ideal portfolio is designed to thrive in, of course, in any environment. You want to be safe in, grow in an inflationary or stagflationary environment or in a better environment. So the key is to have a diversified portfolio, we believe, but also to focus on dividend stocks, which outperform regular stocks. We'll be getting into some specifics in that in this show later when we talk about the dividend pick of the week, but also especially energy, which will do very well in an inflationary environment, energy pipelines, which I believe will do well in any environment. So it's very important to just not get the average returns. And the footnote there is, people say, oh, it's a higher market. But if you look at the returns since December 21, you've actually made some money on paper, but lost against inflation. And that's in the S&P 500, where you had the Magnificent Seven, which many are calling Magnificent 3 or 4 now, boosting the market tremendously. So if you were in those particular stocks, you did well, but the average investor lost money against inflation if they were in the S&P 500. So it's very important to be in the right places. Next section, interesting stories of the week. Our 5 most interesting stories we cover every week. Interesting story number 1. Russian authorities have now detained 11 suspects allegedly involved in Friday's ISIS terror attack at a concert hall in suburban Moscow. And the death toll is now at least 137. So 3 important points here. 1, the U.S. and the Russians should be allies in the battle against terrorism. They have a lot where they could tie together. Number 2, the U.S. and Russia have totally squandered the political, quote, peace dividend that was supposed to happen when the Berlin Wall fell. Everything was supposed to be fantastic in terms of the relationships and spending less on military, but they blew this, and relations are very tense, obviously, and we have the Ukraine war, and it's all a waste because it didn't have to happen that way. And finally, if the unethical mainstream press, and I mean most of it, not all of it, and many Democrats hadn't been saying for at least 2 years repeatedly, Trump is a Russian spy, maybe he could have made had some detente with Putin. I think he might have done that. And maybe we wouldn't be in the war with Ukraine. So, those are all maybes now, but thank you, U.S. corrupt major mainstream media, because you just will say anything for your own narratives, and you may have changed the situation in terms of world peace, and I think you probably did. Some positive news after that one. So higher rates are actually helping pension funds a lot. Pension funds are getting a boost from the Fed's higher rates. And according to JP Morgan, first of all, and this has been an ongoing problem by the way, for years, where both corporate and state pensions have been well underfunded. Corporate, you'll find out in a minute, is much better shape. State, a bit better. So 10 years ago in 2014, JP Morgan, which gathers statistics on the 100 biggest corporate pension funds, showed only 82% funding. But as of last year, they were 99.5% funded, essentially full. Now, with the state and local funds, there's still quite a bit of underfunding, but according to the research by the Boston College, there's been a gradual increase to 78% at the end of the last year from 73% in 2014. So that will affect some states. Sooner or later, they're going to have to catch up, or they'll default on some of those obligations and reduce the pensions. But there still is considerable gap there, but higher rates have been helping them in terms of their bonds and performance, as well as the stock market. Interesting story number 3, not quite as happy a story. So, quote, Biden finalizes crackdown on gas cars, forcing more than half of new car sales to be electric by 2030. The a lead industry group says, quote, this regulation will make new gas-powered vehicles unavailable or prohibitively expensive for most Americans. But it seems like that's the reality. But that's just 2030. We're talking about 6 years from now. It might be hard to buy a gas-powered vehicle if these regulations stay in effect. In a joint statement Wednesday, the White House and EPA, Environmental Protection Agency, unveiled the most aggressive multi-pollutant emission standards ever finalized. This will, here's the problems with this. Number one, this will be extremely unpopular with Americans who don't necessarily want EVs. Obviously, most people know the problems with them. Issues with batteries in cold, cost of the EV batteries, mileage. Maybe they'll improve, but we're talking about 6 years and we don't know what will happen. Maybe. Another point is, and this is so significant, there isn't even really proof that EVs will help the environment, or they very likely won't help it much. There's 2 main points. Number one, it takes about 500,000 pounds of materials to be mined just to get one EV battery. So you're talking about 500,000 pounds of mining, strip mining or whatever. This is a ton of pollution and carbon. And the other, so that makes it borderline at best in terms of improving the carbon situation. But also, we just discussed, I think it was last week, EVs weigh 1,000 pounds more than gas vehicles. So what happens is they burn a lot of tires and brakes because of the extra weight. And those are made of petroleum products. And I think the study said it was 1,800 times more particles being released. So it's really bad pollution that way. Not necessarily all carbon, but really bad pollution that way, on top of the materials being mined. And the third point is, of course, this is going to help China economically and damage a very vital U.S. industry, which is the auto industry. It's going to affect Detroit and a lot in Michigan. So we'll see, but we're only talking 6 years away. Basically, a very limited amount of gas combustion engines being sold. We will see, but there's a lot of questions to be answered, and I think government should have moved slower on this and should continue to look at the studies. It'll be very hard for them to reverse politically, but they should be looking at this and saying, wait a minute, are we forcing the EV revolution when it's too soon? So we will see. Interesting story number 4, back to a more positive story. American companies are paying as much as 36% more premium to workers who return to their offices 5 days a week. The average annual salary offered for fully in-office roles is now $82,000 and change. That's a very big increase from last year's average increase of $59,000. Workers in hybrid roles, however, haven't experienced a very large increase at all and are raking in still around $59,000, about what the other in-offices workers making. That's about 36% less for those who are unwilling to come to the office. So what it says is people are demanding higher salaries to come to the office, and companies are totally willing to pay it. So it's certainly interesting in what's going to happen both in the office market. There's still going to be a lot of vacancies, but also in terms of deciding whether to work in an office or work remotely for many people. Finally, a very futuristic story. The first human to have a Neuralink computer chip surgically implanted in his brain demonstrated how he uses his thoughts to move a computer cursor around a screen to play online chess and toggle on and off music. The chip contains 1,000 electrodes that are programmed to gather data about the brain's neural activity and movement intention, and then send the data to a Neuralink computer for decoding, and so it decodes the thoughts into action. The quadriplegic who became the first test subject said surgery was super easy, and he was released from the hospital that day. So this is coming, and I believe Elon Musk, who's developed this, his company, is saying that he expects or wants many humans to have this, not just people who need it for physical reasons, but just, we'll all walk around with chips in our heads for information or whatever, and hopefully it won't control us. Anyway, we'll take a quick break, and then we'll be back with the dividend pick of the week, which I think is a decent one, and our discussion of the week. See you soon.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Couliet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner, and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
So we're back. So the dividend pick of the week, first, obviously every week disclaimers, it's for entertainment only, no guarantees, only our opinions, and of course consult your financial advisor. So this week we're going with DIVB. That's the iShares Core Dividend ETF. And Wall Street Hackers was looking for another dividend fund for a long time, for at least some time. A while back we recommended SCHD, where we have a 6% allocation. And that seems like a very solid place to be in terms of funds, although we also like to pick our own stocks. But the DIVB, we are now went with a 3% allocation. We finally found that one. So why a dividend fund? This gets back to our favorite chart, which is here. But I'm going to go into a lot more detail anyway on it. We always talk about this. So for 50 years, from 1973 to 2022, if you put $100 into an account in the S&P equal weighted index, you would have $4,000, which sounds pretty good. Oh, at $100, it turned into $4,000. But if you went with dividend payers, it would be $8,000 plus. And if you went with dividend growers and initiators, it would actually be $13,000. So I'd rather have $100 turn to $8 over 50 years, or on the path to that. But here's something else which I've never mentioned before. Dividend non-payers, if you put $100 into 1973, it turned into $694. So, and I never noticed that actually on the bottom of the chart. And dividend cutters, it turned into $74. So you actually, and eliminators. So a company that cut the dividend, is maybe that's obvious, you actually lost money. But if you put in that $100 in 1973, you'd only have 694, which still doesn't seem that bad, right? But you're getting over 10 times as much in dividend payers, and I don't know, 130 times, I guess, no, 13 times more in dividend growers. So I'll go for the 4 or the 8 every day. So we like dividend stocks, and I think it's a key place for allocations. So why do we like DIVB in particular? One, it has a decent but not high 2.9% yield. Now, the underlying holdings have a bit higher, but it doesn't have large expenses, but still, it showed higher. But it has an excellent history of dividend increases. If you pull it up, it's pretty amazing how it's been increasing since it was formed. The focus of DIVB is that it invests in U.S. companies that return capital to shareholders through paying dividends and or buying back their stock. So that basically goes with our philosophy, which is look at the cash flows. So if you have the cash flow to buy back stock or buy back dividends, that's the kind of company that might offer more safety and more growth. The price to cash flow in DVB's portfolio is 11. So that's a 9% cash flow yield. Sales growth, even in this environment, has been decent at 5% over the last year. 1.7% cash flow growth in this environment. Again, I say because of rising inflation, a lot of companies were stressed, but it's still growing at a little under 2%. But long-term earnings growth was 9.1%. So obviously, Wall Street Hackers has bigger allocations to pipelines and energy, where we think is the place to be number one. But you want to have diversification. And as a long-term investment, even if we hit a stagflationary environment or inflationary, even higher inflation, DIVB should be more defensive. And if inflation doesn't get out of control, if we don't hit stagflation, it should be a real winner. Either way, it's a good diversifier. And we will see. But the theory of Wall Street Hackers, which is one of my most solid, I believe, is governments of the world are going to use what's called yield curve control to bring inflation down to, bring rates down to near zero, because they're going to be printing money left and right for all these on-the-books deficits and off-the-book deficits like Medicare and or free retirement in other countries, retirement health benefits. So the bottom line is, if rates do come down, that'll be a tailwind for these companies, and at least we'll be getting yields, because it's going to be hard to get a yield in a zero rate environment. And probably 3 or 4 years, we're going to be heading that way fast. We'll see. I can't time it exactly, but you have to think about the long run. So panel discussion of the week, and Nick will be coming on. And the question is, what is the Fed doing? Hey, Nick. And why is it doing it? So background. First, as just discussed, energy prices are now rising, and they contributed to decreasing inflation in the fall. There are 8.8 million unfilled jobs in the U.S. The government is spending, and the off-the-books liabilities are gigantic compared to even what they admit. They should be saying there's $125 trillion in liabilities right now, not $33 trillion in the liabilities they admit. It's huge. So in February, the Congressional Budget Office released its annual budget outlook and projected that the nation is going to run 1.6 trillion deficit in 2024. The debt to GDP ratio is expected to increase from 99%, it's already at 99% in 2024, to 116% in full year 2035. The CBO projects federal budget deficits will total 20 trillion from 2025 to 2034. What's another 2020? What's an extra 20 trillion here or there when you're already 125 trillion for Medicare and other unfunded deficits? So in December, Fed Chairman Powell said he sent a very dovish message to the markets, and that probably is why the markets are up 35% year to date, roughly. But on the other side, it says, oh, great, new highs, 35%. But in reality, if you've been in the market since December 21, it's not really great, because it's a nominal new high, but you've actually been earning a little over 3% and losing money against inflation. Unless, obviously, if you were in the right Miracle 7, maybe you outperformed, but the average S&P 500 investor lost money against inflation. So it's not quite as good as it sounds at 35%. And so this week, the FOMC meeting surprised many, because they revealed that the Fed still intended to cut 3 times. We've been saying forever, it's not going to be 6, it's not going to be 5, not going to be. Now we're saying probably not 3, very unlikely 3. but there was admittedly a close vote, and there were only one vote off lowering it to 2. So, question of the week: what is the Fed doing, and why is it doing it? Nick?
Wow. Well, that's a hard one. Well, the thing is, they're holding steady right now, Peter, because they believe they have inflation under control. When I say believe, they have systemic problems at the government and federal level, and one of them that you brought out, which is the increase in the deficit and the debt to GDP ratio going to 116%, unprecedented. And here's the real problem. The national debt's 34 trillion. It adds 1 trillion every 100 days. This is a major problem with a high interest rate environment. Every 100 days, we add another 1 trillion. Another problem, which you just went over, the budget, the Omnibus Act, which was just published, was over 1,000 pages, where the budget is only 188 pages. So what's in this Omnibus Act? We counted, and some other people have counted, over 15 billion in earmarks, money that's spent on the Michelle Obama Trail, 3.6 million.
Oh my
A
God.
museum in Palo Alto, California, a history museum, 3 billion. And it just goes on and on.
That's a
Pride
billion
centers-
here or there, right? When you are
Yeah, well, the
35 trillion.
arguments by the liberals have been, hey, it's only 4% of the budget, but that's not true. What happens is 4% of the omnibus budget, it's only 51 billion plus interest forever. So we have a real problem spending in
We sure
Washington,
do.
D.C. And I found interesting, he said, oh, we're going to put everything to EVs by 2030. Biden shouldn't be dealing with this. This can be taken care of by the market. What's he going to do about Medicare that will be completely broke by 2030? And what's he going to do about Social Security that's broke right afterwards? I found something very interesting about your politicians. They don't want to touch the tough issues. We do touch them on Pod TVs with the Honorable David M. Walker, the former Comptroller General of the United States. But the media doesn't want to touch it. The politicians don't want to touch it because
It's too difficult. They don't want to admit the truth.
Exactly.
They'd rather hide the truth and say, we're spending too much. We have to cut something. It's easier to spend than tell people, we have to be frugal.
That's true. And they don't think really in terms of turning the economic malaise around, which I even suggested on one of our shows, and Sasha actually had a good addition to it, that the immigration, we start charging fees. Like I'm going to go to, I told you about going to Spain. They charge you fees. You just can't.
Yeah, no, every country does. But
Except
let me
us.
jump in because we're always short on time. So,
Yeah,
but
yeah.
those are good points, and exactly right. But that's just an example of the government should be operating at maximum efficiency. There's so many places where it could be create more production, or even get more tax revenues, without hurting the economy. But it's just there's no progress really. So a couple points. One, it's very hard to know what's driving the Fed dialogue because. One, some people say it's politics. Other people say it's what they believe, but it could also be wishful thinking. What's certain is there is no certainty here. But they are giving these dovish messages in an environment when they cannot be certain. I don't see how they can possibly be certain. And they were behind the curve for a long time, maybe a year and a half, in raising rates. So it could just be wishful thinking. And one of my favorite expressions is a lot of people see the world the way they want to see it. And that could be the Fed right now. The other thing is, because we are running short, is this could be very dangerous in the long run because higher for longer is going to clash with these deficits. And what's going to happen is the U.S. government and the world is going to need zero interest rates because they can't pay interest on these obligations. So they're going to use yield curve control. So which you can look up because we don't have time to explain it. But basically, when we get to zero or low interest rates, that's going to stimulate the economy and stimulate inflation. So they need to get it down quick, and they're not doing that. And if this is going to take years to take, this is going to clash or collide with the need for zero interest rates because they can't pay interest on all the money they're going to be printing. The press will be going full guns. So unfortunately, this wraps our time up, but I think we gave you some pretty good conclusions. Thanks for watching Wall Street Hackers. We'll be back next week.
Yeah, and just one last note to that. Today, the largest budget item, Peter, in the U.S. government is just interest on the national debt, which we get nothing for. It's now the defense budget, largest amount of money that your taxpayer dollars are going to is to do one thing: just pay interest on the national
And it's going to
debt.
get much worse, obviously. In
And
the
it's
end,
going to get worse, right?
Just like Einstein, we're over the 30, but a lot of people can watch a little longer. So, but the
Right.
point is, Einstein said the compounded interest is the miracle of I think the eighth miracle of the world or something like that. But the point is, it works in reverse too. If you're owing money and it's compounding, it's a disaster waiting to happen. And so we will see, but we are out of time again. So we will
Right.
see you next week. And thanks for watching Wall Street Hackers.
Bye bye.